We're going to bring up our first panel of the day. This is the European Consumer Online Lending panel. And it's moderated by Cormac Leach. And Cormac Leach is an analyst, he's in equity research at Liberum. They're an investment bank based in London. And he actually produced a report a few weeks ago that has been widely talked about in this industry. In fact, if you saw Renault's presentation yesterday, a couple of slides from his report made it into Renault's report, Renault's presentation here yesterday. So he knows this industry probably better, particularly from the European perspective, than anybody else. And I'm fascinated to hear what he has to say and what the panelists have to say about peer-to-peer lending in Europe. So over to you, Cormac.
Hi, good morning, everybody. Hopefully people aren't too hungover. Still interested in hearing about even more platforms. So this is the European peer-to-peer panel discussion. And I mean, you could argue, as you see, as we talk about the peer-to-peer, you may actually ask for it to be renamed the UK peer-to-peer discussion, but we'll continue. So I'm Cormac Leach. I'm an equity research and investment banker from Liberum. We're based in London, and we've been focused very much on peer-to-peer for the last 1 or 2 years, connecting platforms and investors. So if you're a platform or an investor, we're delighted to hear from you. If you get in touch, if you think we could help. So on the podium, we have key management from 5 of the leading European platforms. So in no particular order, we have Lisa Griffith from Funding Circle. We have Peter Behrens from RateSetter. We have Raphael Jonin from Oxmoney in Germany. We have Jonathan Kramer from Zopa, and we have Stuart Law from Assets in the UK. I think we've got a lot of intellectual property on the stage. Could I ask, Lisa, maybe you could kick it off. Could you maybe describe your platform, what you do, how long you've been operating for?
Sure. So I'm from Funding Circle, which is an online marketplace connecting investors directly with small businesses. We've been running in the UK since August 2010. We launched last year in the US, and you might have heard Sam talk yesterday, who's our MD here in the US. So we're the largest global player in the space, and we've lent about $500 million to date.
My name is Peter Behrens. I'm the CEO and co-founder of RateSetter. We are a peer-to-peer platform connecting consumers on both sides. So we're doing consumer lending in the Lending Club Prosper model, and we are currently entirely funded by retail lenders. Obviously, that's an issue for some debate, whether the institutional money is going to pile in or not.
We'll get onto that later.
Well, I'm sure we will. And we launched in October 2010 and are there and thereabouts.
It's fair to say you're rapidly catching up with Jonathan, right? I mean,
I'm sure Jonathan would be delighted to hear that. Yeah, I think if we were going to be fair, if we were going to be fair, we'd say they were the same size now. I think month on month, it depends. One of us will lend more than the other.
My name is Raphael Jonin. I'm the CEO and co-founder of Oxmoney. Oxmoney is a peer-to-peer platform based in Germany. We bring together investors and consumers. And the way it works is similar to Lending Club and Prosper here. So in the way that we exclude a certain amount of borrowers, and those borrowers who make it on the platform are then put into various core classes and assigned an interest rate, so that the investors, private investors and institutional investors can make investments into particular loans, so no pooling of loans. We've been around for 6 years, generated over 100 million of volume with strong growth recently, are looking for or will expand into other areas as well.
My name is Jonathan Kramer. I'm the sales director at Zopa. Zopa is the world's oldest peer-to-peer lender. We operate exclusively in the unsecured consumer credit space. Zopa was established in 2005. Life to date has facilitated just under $900 million of loans. Growth has been very strong. Last year, we grew at about $370 million.
Stuart Law, Assets Capital. We're a secured business and property lender in the UK. We're a peer-to-peer platform fully funded by private investors currently. Average rate of return currently about 12% per annum on a secured basis. Average loan to value 63% across the book. Funded approaching $50 million of lending and approaching $10 million a month of transaction level, growing about 20% a month, compound.
Okay, that's very useful. I think, Stuart, you like to make much of the fact that from inception you're growing faster than Lisa, actually, is that
Yeah, but the market's more advanced, but yeah, we're growing particularly quickly, yes.
Okay,
yeah.
And I mean, if we just kind of have some broad kind of, themes for questions. I mean, if we look at the value proposition to lenders, first of all, Lisa, could you talk about what kind of net yields lenders can expect to get from the platform, and maybe also, that in the context of what kind of loan losses people should see on the loans?
Yeah, sure. So on Funding Circle at the moment, investors are earning between 6 to 7% net yields. Now, that's kind of built up across our loan book, which has been going for 4 years now. So there's about 4,000 businesses that we've lent to since inception. Our loan defaults at the moment, our losses are annualized at 1.6%. So what we've seen is kind of over the years, we've managed to improve our credit performance, and we're performing in line with where we would expect to be.
Okay, Peter?
On RateSetter, the yields are a bit lower because we offer a sort of quasi-savings product. So our lenders are protected by what we call a provision fund, which was an innovation that RateSetter launched with, which means that every borrower pays a fee into this fund based on their creditworthiness. So the lender is exposed to the risk of the provision fund being there to protect them in the case of default. So we also offer shorter term lending proposition than some of the others. So as a lender, you can tie your money up for as little as a month. And that's a sort of an alternative to an easy access savings product. And we go out to 5 years like the others. But so the yields on that are sort of 2 to 5%. But no lender has ever lost a penny on RateSetter. So I think we're the only peer-to-peer platform of meaningful scale that can really make that claim. Stuart's teetering on the brink of meaningful scale and probably actually would say he isn't meaningful scale, so I might be being rude and it's unintentional. But the model is very much about creating a consumer-friendly savings product.
Okay, Rafael?
On Aux Money, the average yield that investors make is between 6 and 6.5%. On average, so we have various score classes going from A to E. If you invest in A, the average yield would be around 4.5%, and that goes up to 7 and 7.5% towards the riskier E class. So as I mentioned before, we've been around for 6 years. If you look at historic cohorts, you'll find that there has been a very stable performance over the past years. And I think it's fair to say that Germany is also an economy which is very stable, also in terms of against financial backdrops. So that is something that that investors like about our platform, also international institutional investors in particular.
On Zopa, if you look at historical returns, if you look between 2008 up to the end of 2012, where we have either fully seasoned or fairly seasoned loans, net returns have averaged 6.4%. Average annual default rates have been 70 basis points. Zopa has always operated a very low risk model in terms of very low defaults. Current expected returns would be a bit lower in the mid-5s. We also operate what we call a safeguard fund for our retail lenders, which is very similar to the provision fund. We may talk about some of the reasons why we do it. It simplifies the experience for the lender, but also solves some particular tax issues that exist in the UK, where for retail lenders, losses are very inefficient. And so a safeguard fund or a provision fund is very efficient from a tax point of view. But for institutional lenders, which is something that I know we'll discuss and we're starting to introduce, there is the ability to turn that safeguard fund off.
Yep, our blended weighted return is about 11.53%, I think, currently today. But we offer a range of products. People looking for very low risk, savings proxy type products, we'd be offering about 4% on 30 to 50% loan to value residential property security secured loans, up to approaching 15% on other secured bridging loans as well. So we've always got tangible security, but the range of rates varies by product type, not so much security, which is a bit interesting, because you can get a similar level of security producing a return in different product markets, ranging from 4% up to about 12% for pretty much exactly the same quality of security. But that's just the nature of the markets we operate in. And the blended return, I think going forwards from ourselves, is going to trend towards about 9 to 10%. We don't have any lender fees, so those are net rates. And we have a secondary market, which doesn't have any transactional costs either. So people can diversify, possibly using our automatic tools to create a wide diversified portfolio by auto trading without any actual transactional costs impacting on that.
Okay. Thanks. So when I hear these numbers, I kind of think, a little bit boring actually. So, they're kind of mid to high single digits, and the strong sense I get is that the European peer-to-peer platforms may possibly be, they could be accused of playing it too safe, not going up the risk curve enough to generate returns. For example, yesterday I'm hearing from some US SMEs that, net yields can be 20 to 40%. Stuart, you're probably the least guilty of this in terms of, not going enough up the risk curve in some of your products, right, to go out to generate the attractive net yields. I mean, the question would be, what's the maximum gross yield that you will charge a customer? And is there scope for you to go dramatically up the risk curve to generate some attractive, juicy net yields for investors?
Yes, I think if, in our trade finance side, we're charging 4.5% per month typically on invoices and so on. That's producing some hefty annualized figures.
What's the net yield on that work out?
Well, because of the fees and the transactional costs and the broker costs, we're looking at producing a rate of about between 1 and 2% per month to lenders.
Persuade Giles to go up the risk curve?
Yeah, I think that Zopa has always offered a very low risk model. I think the reason it grew up that way is a couple of reasons. One, being the sort of the grandfather in this industry and being the first, it was fairly important in terms of building trust with regulators, press, users. We've introduced these safeguard and provision funds to try and address some of the tax issues, but taxes also played a role in that bad debt is very inefficient for the retail lender in that they can't offset bad debt against interest income. So again,
that's no longer true with your safeguard fund, right?
That's right. So the safeguard fund kind of addresses that.
Can you explain briefly how that works, actually? Because I think US investors probably are not familiar with it.
That's right.
They don't have the issue in the US.
So if you're an investor if you're a retail lender in Zopa, you get a broad exposure to the blend of to the blend of borrowers. You don't choose by risk grade. And the part of the borrower fee is applied to what we call a safeguard fund, which is where we are estimating potential future losses. And we benefit from having a fairly long track record of credit history to look at in terms of how loans are performed. But if there are defaults on your loans, the safeguard fund steps in and makes good that that payment. And so as a retail lender, the benefit for you is that while it's not an insurance product, it is an added layer of protection that you will achieve the rates that you're expecting. And from a tax perspective, it means that you are receiving a sort of close to net fixed return, and you don't have the problem of paying tax on your gross interest income, but not being able to offset bad debt against it.
Okay, I'm not sure if you answered the question. I mean, what's the maximum gross yield?
In the teens.
In the teens?
Yeah.
And is there scope for you to dramatically go up the risk curve, or you just don't want to go there?
So I think we are judiciously taking steps to broaden the risk mix. I think it's very much in the culture of Zopa to make sure that we're doing that judiciously. But it is fair to say that the risk mix is broadening.
Okay. Okay, and I mean, if I was an institutional debt investor, let's say in the US or globally, and I come to Zopa and say I'm targeting net yields of 12%, can I find a segment of your loans that can generate that for me?
Well, while there may be segments of the loans that could generate that, we operate a model where you get the blended return. So in my argument to, let's say, U.S. institutional investors that may be thinking of broadening outside of the U.S. investing with Zopa is that if you look at the risk return characteristics of the kind of Zopa universe, you're probably talking about something that if you look at a lending club and you look at their sort of seasoned returns, you're operating in sort of a B-ish type range. Our journey to get to that return, though, is very different, where we have lower gross lender yields, but also much lower default rates. So your confidence of actually achieving those returns are greater.
So is it fair to say that your loans should be susceptible to effective securitization? I mean, it should be possible to aggressively lever up your loans a bit like, say, a rated lending club.
And one of the things we're starting to see is, so we're just at the beginning of this in the UK in terms of some potential institutional participation amongst the lender base, is that while no one has achieved leverage yet, those conversations are happening. So if I'm an institutional investor and I have the kind of target yields that you're talking about, from a risk return perspective, actually you would potentially be better levering a very low risk Zopa return than potentially going down the risk curve to achieve this.
Right. I think it's fair to point out that the credit performance that these platforms are generating in consumer finance are somewhere around 3 or 4 times better than the average performance from banks in general. This is very high quality consumer finance underwriting. And I think, Raphael, you're in a similar space. I mean, you're playing to the quite high quality borrowers, but you also have regulatory issues, don't you? So the government or the regulator limits the maximum gross yield that you can charge, is that right?
That's right. So the answer to your question would be that there's no opportunity to go further up the risk curve because there's a cap in Germany on the maximum interest rate.
What is that cap?
You can charge. There's no hard number. It's but we are on the cautious side. So the maximum nominal interest rate that we charge to borrowers is at 15%, 1.5. So anything beyond that, we can only make whole by accepting, and we do that, collateral. So if there is a borrower who's willing to pledge his car as collateral at a high or low loan to value, then that can make up for potentially being a less lower quality borrower, so that the expected return in that particular risk class can still be achieved. And that's one way to come around that and still widen the scope in terms of borrower quality.
Is it fair to say, you have about 5 or 6 years of loan data, including right through the financial crisis where the loan losses performed very well. So, for investors looking for low volatility returns, actually, you have quite an impressive track record. Is that fair?
That's right. Obviously, when we started 6 years ago, the volume was still low, but we also do see that, what you just said. But if you even look at market data, which clearly goes back a long time, and you compare that to other countries, US, UK, you will clearly see that whenever there was a economic downturn in the US, in the UK, there has been a spike in default rates, whereas in Germany, it has been pretty much flat. And I think that's the particular appeal to lending to German high-quality borrowers.
Okay. So Peter, is it fair to say you've always been slightly more risk-taking than Zopa in terms of your risk appetite and generating slightly better yields? Is that fair?
I think initially our yields were slightly better because it takes time to earn the credibility that you're an established platform. And when we came to the market, Zopa was 4 or 5 years old. They were an established platform. Their lending community trusted them, so they were prepared to accept a lower yield. On day one on RateSetter, the yields people were asking for were quite interesting because we had to demonstrate that we were a credible platform as much as anything else. I think have we been more adventurous than Zopa in the people we lend to? I don't think we really have. I mean, I really enjoyed Jonathan's phrase, broadening the credit mix, which I thought was a lovely way for sort of a lovely euphemism for charging down the spectrum. But we are, I think we are, both Zopa and RateSetter to take a very pragmatic and, or not pragmatic, prudent view to consumer credit, and that we have not wanted a sort of wobbly ship. We've wanted a pretty consistent story, and we have absolutely performed where we expected to on our credit projections and plans from the day we launched to today.
Okay, and what's the maximum gross yield that you will charge borrowers currently?
Oh, I mean in the teens as well.
In the teens, so is that low teens, high teens, mid-teens?
High teens.
High teens, okay. And what kind of net yields can one expect on those loans where your gross yield is high teens?
Well, at the moment, because the spread is all taken by the provision fund, it is, if you're a lender on RateSetter, you get, at the moment, one rate.
Okay. But, I mean, we can come on to it later, but I mean, is there any willingness for you, you know, if someone starts to become a credible long-term source of funding for your platform, for you to kind of change your proposition and, you know, start to give institutional people access to whole loans on your platform? Is that a direction you're willing to contemplate going in, or you just
we're very,
philosophically opposed to it?
I think, so to put my cards on the table, RateSetter philosophically believes that we set ourselves up to offer a retail proposition, which is an important proposition. I think, I believe very strongly, and we believe very strongly, that if we can deliver great value to the consumer, that is a formidable thing to be delivering to the world. And there are some very charming people here and in the UK who work for institutions who I like very much. But frankly, RateSetter offering them a product doesn't really change the needle on their lives. However,
well, it could do if you become big enough, right?
No, I know, but I was more on the emotional thing here. But I think there is a point in time, and we may well be at that point in time, where the institutional money will serve an incredibly big benefit to us if we wish to upscale a bit more quickly.
It should play a part, perhaps, in your kind of diversified sources.
Yeah, I mean,
we'll come back to that.
Cormac, we are talking to obviously one or two people, and we are prepared to entertain these conversations.
We'll come on to that a little bit. Okay, Lisa, if you look at your maximum gross yields that you will charge borrowers, what is that number currently?
So it's, on average, it ends up being about 10 to 12%. We have an auction system where we have a floored auction, and the highest rate that an individual investor can bid is 15%. So that's as high as we would go, and in reality, it's a bit lower than that. I think I'd echo, you know, what other people have said. You know, as we started off being very conservative with our underwriting process, and the idea was to build credibility and to build a good track record in terms of our loss rate over time. Now we've actually kind of broadened that, broadened the risk over time, and we introduced C grade loans and C minus grade loans, which are actually kind of extending down and further along the credit spectrum. One of the challenges we have with the retail lending market is what Jonathan spoke about, so the tax challenge and the inefficiency of bad debts in the UK market. And so we've, you know, at present haven't gone below the C minus risk grade. You know, there's always opportunity to increase that. But I think institutions coming to us are talking about the diversification opportunity. So they're in the US, they're in consumer in the US. And actually we have a different product. So we've got business lending. You can look at the loss rates over time, and we've got the track record to see, and they're about 1.6 on an annualized basis, which puts us in that top grade of the Prosper Lending Club loans, which means that kind of, you know, they can have similar conversations around leverage that they're getting here in the US. And a lot of the investors who we speak to are looking to port that across to the UK.
Interesting. And you know, if you speak to some platforms in the US, you know, they have no qualms about charging 60 to 100% gross yields. I mean, do you have a philosophical problem with charging those kind of yields, or, you know, why are you limiting it to 15%, frankly?
I think the credit, the risk that we're taking on the borrowers is very different to what those providers are taking in the US. And if you look at kind of the comparables in the market, I mean, we compete more on speed, but we're competing, you know, with banks and other providers who wouldn't be charging those rates. So we're in a different category.
Okay, and is that because the higher, you know, so there is a new segment that you could choose to go into? Is it that it might be too small for you for it to generate a meaningful amount of revenue for you, or, you know, why are you not interested in that high yielding segment?
So today it's been the challenge with the tax challenge from the retail perspective.
But you could, in theory, set up a provision fund or safeguard fund that would neutralize the tax.
We could do. Yeah. I mean, the challenge that we have with that is that about half of our investors go on and look at each specific loan. So we provide a lot of information because we're doing business lending on the specific business, so the financials of that business. And a lot of our investors are spending time and energy doing their own diligence on the platform. So for them, it's a different lender than the consumer guys, than Zopa and RateSetter, and they don't want to see their returns. You know, they're betting on a better profile, so they don't want to see their returns decreased by kind of supporting the leveling out of the returns over the book.
Okay, could we change the theme actually? We've talked about the value proposition to the lenders. Could we kind of talk a little bit about the value proposition to the borrowers? You know, so you can compete versus other providers of loans in terms of price, speed, and convenience. Rafael, could you maybe talk about how are you competing with the banks? Are you providing lower rates, or are you more convenient, or are you just faster? Or is there something else that helps you compete?
Yeah, so first comment would be that in Germany the structure is that the banks only go for the super prime borrowers. So if you qualify for a bank loan in Germany, probably the bank will charge you between 4, 6, maybe 7% APR. So it's very low. That's not the market that we are after. We get actually more and more borrowers of that segment as well, but it's not something that we are actively marketing for. So we are in the what we call prime segment, and there, very, very few borrowers actually do have access to bank lending, or only via overdrafts, which is the German equivalent to credit card debt here in the US, which is very expensive.
So it's quite polarized in terms of the bank offering. Is that fair?
Yes, it's very expensive. There is no risk-based pricing, so everybody pays the same, and obviously the good quality borrowers that take money via overdraft find a cheaper alternative in Aux money. But at the same time, obviously, we work hard on offering a better experience to the consumer. Everything from the registration process through to what kind of information we ask for, how efficient the underwriting process works, and we put a lot of emphasis into that as well, like we have our own intelligence around what kind of borrowers do really ask for employment verification.
You actually have an information problem, don't you, in Germany, that there isn't as much detailed, there isn't the equivalent of FICO scores, Equifax.
Well, there is. They're very strong. The Schufa score is...
But isn't it true that Schufa just tells you if the guy's a really bad credit? He doesn't tell you if he's, a good credit or a very good credit.
Yeah.
Which makes the risk-based pricing slightly more difficult, right?
Yeah, I mean, we consider the Schufa score to a meaningful extent in our risk model and in our scorecards, but there are other criteria that you would need to implement as well to make the whole picture and to be very accurate in terms of assessing the quality. Okay. So I think it is it's a strong indicator, but not as strong as the FICO score in the US, where I think it's definitely the main component in any score class.
Okay. Could I invite Jonathan and Peter to maybe compare and contrast, in terms of your propositions to consumers? I think, Jonathan, you compete slightly more on price. Is that fair?
Yeah, though also, I think a large part of it is also the consumer, service element of it. I mean, we struggle in the UK, like I think, peer-to-peer struggles everywhere in terms of awareness. But those who are aware are quite supportive of it. So, for example, Zopa for 4 years in a row has won Best Loan Provider of the Year, whether, and that encompasses the traditional players and the alternative. So I think the user experience is quite important because we want to try and differentiate ourselves. Price certainly plays a role, and price comparison websites are. And
because if I look on Money Supermarket, frequently you're the lowest rate.
Yeah,
from a borrower.
and I think part of that is because we're battling a brand problem in that people will have heard of the established big banks, and so if
even if you're cheaper than Barclays, people may still prefer to borrow from
right, but certainly if we're more expensive than Barclays, they would go for Barclays.
If you're cheaper, they might choose Barclays.
So it's important to be sort of near the top of that, but also I think that the customer service bit is is also important. And I think this is kind of the whole ethos of Zopa is to be, incredibly well considered. And I think it's helped the peer-to-peer industry grow in that, there's tremendous support from the press, there's tremendous support from the regulators, there's tremendous support from our existing our users, which has meant that even though we've operated a completely retail model also on the lender side, and of course, naturally on the borrower side, we've managed to get to a place where we've made 90,000 loans, and we have 50,000 savers. So it's, trying to establish that trust and that user experience is a big part of the USP.
Can I turn it over to Peter? So,
yeah.
I mean, are you broadly in the same space in terms of competing with the banks?
Yeah, I think so. I mean, I think the big difference in the UK environment versus over here is in the US, it appears to me that Lending Club and Prosper are absolutely top dogs in the world of the installment loan. The installment loan is not a mainstream banking product. In the UK, the consumer installment loan is a very, very, very big product. And the banks are doing the vast majority of it, despite not having a great appetite for it. Their customers come to them, ask for it, so they deliver the product. But we also have another thing, which is we have big supermarket banks who are very, very aggressive on this product because they use their cash reserves to fund it. And so there are two...
It's quite a competitive space then.
So it's a competitive space. And basically the banks are actually pretty good on service because they're very quick because it's their own customers and they can just nail it, but they're expensive because they don't want to deliver the product. The supermarket banks try to be good at service but are in a bit of a muddle because ultimately their job is to sell baked beans, not loans. Okay. And they compete very heavily on price. So what we try to do is you beat the banks on price, you beat the supermarkets on service, and that gives you an opportunity to be there and thereabouts.
Got you. Stuart, can I turn it over to you? I mean, what's your value proposition? I'm guessing it's speed, right? From talking to you, you don't typically do everything quite quickly, so I'm guessing that you could fulfill loans faster than everyone else. Is that fair?
Yeah, it's partially speed. We've done transactions with security taken in 7 days, which is faster than the bank opens the email on the whole. For the,
you also have a slightly different model, don't you, in terms of you like to actually have the money to hand immediately, so it's not like you need to wait for the loan to get matched. Yeah, right?
I think if we went through the pipeline of our proposition, we're a bit like a 100-year-old banking model, so we have relationship managers in the field. We visit the customers, we see them, we can have the luxury of that because our average loan size is about $500,000. We look at the business, we read the accounts, we employ 20, 30-year experienced bank managers typically as our relationship managers, so they know how to read a set of accounts, they know how to look at a business, they'll spot problems and opportunities. They'll also offer the right product from our range of business loan products for the business. And then we move quickly. They pass through the credit pack, our credit team in head office then review that. We price to risk. So we do not operate reverse auctions. We've done one ever. Everything else is fixed rate, and we'll stay at that level because it's not appropriate for lenders to try to second guess. We don't feel what the correct rate is. So our borrowers get an appropriate rate for the given security, for their given cash flow and affordability of repaying that loan. Okay. And it's very much a strong credit proposition, and borrowers get to speak to somebody. Right. That's the key difference. Yeah. They get to explain their business, and we price accordingly.
Okay, can we? We just have a limited time actually. Can we turn it over to sources of funding? Lisa, could you talk, maybe a little bit about what's your ideal mix of funding for your business? Do you have this philosophical problem with institutional capital, or what percentage of your total funding would you like to see from institutions? Would you consider partnering with a bank like Lending Club announced yesterday? Then kind of following on from that, how much institutional debt capital would you be willing to accept, perhaps from this audience or other audiences, say over the next 12 or 24 months?
A lot of questions there. So we're very open to institutional capital. We think that the way that this marketplace grows is by having a large depth of different investors on the investment side. So part of that is our retail base, which is very important to us. We've lent, last year we lent 130 million, primarily from retail lenders, but also part of that came from the UK government, who lend through our platform as part of a way of encouraging additional players in the market for businesses to access finance. So, over the next year, we've been doubling volumes each year, and we hope to continue that over the next 12 months and beyond. The challenge is that, with retail capital, it's quite easy to make the small jumps, but then going larger, and when we're talking about, moving up from 130 million pounds up to sort of 300, 600 million pounds, then that's when I think institutional capital will come on board and will be very supportive. So, roughly over the next 12 months, we did 130 million last year based on a predominantly retail base. This year we want to do kind of in excess of 300 million. So, the gap is where we'd like institutions to come on board.
So, if you could have an ideal number that could just magically appear in terms of incremental institutional capital, what would it be, say, over the next 12, 24 months?
As much as we can, really.
As much as we
we get a lot of demand from borrowers, and there's a lot of good borrowers that we're still seeing. And the constraint at the moment is on the capital.
You're turning away borrowers because you don't have the other side of the equation, as it were. Okay. And Stuart, where would you stand? How much institutional capital could you absorb over the next 24 months?
Yeah, currently we're fully funded by private investors, but absolutely we're open to institutional money. We see it as very complementary. We don't see it as one taking the other. We're providing a range of financial services growing over the next year or two. And institutional capital gives us scale, and scale gives our retail customers diversity and choice of products. So we could deploy hundreds of millions of pounds sterling without any trouble at all over the next year or two in a range of products, from property development funding, bridging, trade finance, through to term loans for businesses, a range of products.
Okay, and then just briefly, because we kind of want to move on to other stuff, Peter, where would you stand on that? You don't want any institutional?
No, actually, but I just say these things because I find they're more amusing to say, and it's contrary to what everybody else has said. I think the reality is institutional money is going to be a part of RateSetter going forwards. In an ideal world, we see RateSetter as effectively a money market, and money markets should be of a scale where everybody can participate. The Holy Grail is a place where institutions, individuals, the whole place price the thing the same. They want to receive the same yield.
Would you consider partnering with a bank?
Yes. It would depend on which bank. But yeah, no, of course. I mean, sure. I think if somebody has something sensible to say to RateSetter, we'll have a conversation with them. I mean, we did a. Well, no,
and Jonathan, what's your number over the next 24 months?
Well, I'd say, at the moment, what the situation we're in is a little bit opposite than the situation which, our peers in the US are in that for us at Zopa, borrower demand is outstripping lender supply. So, we would be, very welcoming of institutional capital. In terms of the amount, something around, 10 million pounds is about $17 million a month would feel about right now.
Okay, no, that's helpful. Okay, we're kind of just a limited time, but one thing that strikes me is, this was built as European peer-to-peer, but if you look on the podium, there's 4 UK and there's 1 continental European peer-to-peer. And my question would be, as far as I know, Europeans invented banking. So where's the rest of Europe? So there are no Spanish, Italians, French. Raphael, maybe I can ask you. Where are your counterparts across the rest of continental Europe?
Yeah, obviously, Aux Money just focused on Germany for the time being. We had briefly looked at other countries. We didn't find them that as attractive for various reasons. One is regulation. One is having banks that are very strong and lending at very competitive rates. So, and then sometimes the data quality is not really good, and it would take a long time to build your own model.
Is it fair to say the regulator's a little bit backward in the rest of continental Europe? They're just blinkered in the pocket of the banks, perhaps, or is there some bureaucratic red tape which is holding back the sector? Because, I mean, if I look at the gross volumes as a percentage of GDP, if I look at the US and the UK has basically double the GDP penetration of the US, but Europe is about 10 times less penetration. So it looks like the UK, frankly, is ahead of the US in terms of sophistication of the innovation and the evolution, whereas Europe is 10 times behind. So is it a governmental regulatory issue in continental Europe, or is it a cultural thing, actually?
I think, the way we looked at it is that regulation makes it very difficult to carry out this business in a way that the government or the regulator will not shut you down. Okay. So, and obviously that's the key. And certain countries don't offer that. And I think in Spain recently there has been a change in regulation which puts the P2P platforms that are out there in jeopardy. And that's certainly something we as a company want to stay away from.
Okay. So I mean, the obvious next question would be, you know, is there a land grab opportunity? You know, I mean, Stuart, if you start studying up on your French and your Spanish and your Italian, you know, could you go out and capture a huge portion of the European peer-to-peer market?
The answer is yes. Yeah.
Okay.
Yeah.
And
absolutely.
what would you need to do that? I mean, do you need to raise some equity, perhaps? You know, that I can help with.
Some equity and yeah, always the sales pitch. I think it's about quality of team. We're looking at franchising our software out globally. We've already got four conversations going on around the world. We're not going to use our brand initially, but we're really interested in who's got loan origination skills, credit depth, credit skill, and funding potentially. Okay. Although there are models that don't require a party that we work with to have funding.
Good. Okay, we've got 4 minutes left. I mean, is there anybody in the audience who's got any questions, or is everybody still kind of recovering from last night? Well, just maybe while we're waiting, I mean, the question I have is, you know, Lisa, if you're looking at where you might expand next, I mean, obviously you've expanded already into the US. Would you be more, you know, is your next step to go to another Commonwealth country, like perhaps Canada or Australia, or would you look at the SME opportunity in Italy, for example, in terms of your next step, without giving away any confidential information?
I think there's a lot of interesting markets actually, for different reasons. I think this model works globally. I think there's an inefficiency across the credit markets for small businesses globally. And you know, Australia looks interesting, some parts of Europe look interesting. There's different challenges in each around regulation, around credit data availability, and around kind of the market and distribution channels. So it's just really a weighing up of those and seeing where they come out.
Okay. And Peter, you recently announced you're going to Australia, if I'm not mistaken. I mean, do you expect Australia to be a meaningful proportion of your mix going forward? You know, a steady state 5 or 10 years from now, could Australia be a meaningful proportion of your total origination?
I very much hope so. I think they've got, I think the market there is a fantastic opportunity for peer-to-peer to become a really powerful force. I think, you know, we've got a fantastic local team, and we raised a bit of money locally to make it a genuinely Antipodean operation, as opposed to a sort of UK people flying around the whole time in a sort of slightly chaotic fashion, because I think we've all got very young businesses, and we are, whilst you talk about having great penetration into the UK, I think we are very much at the foothills of the opportunity.
1% market share.
This is my point, right? It's absolutely tiny, and we need to build that market share and become a meaningful participant in the UK financial services system.
But you could see a scenario where you've got, I mean, my numbers, you can get 30 to 50% market share of the UK, let's say in 10 to 15 years. So you probably do need to move further afield to...
Yeah, ultimately, yes. But at this point in time, to get from where we are to 30 to 50% of the UK financial services market is going to require some work, shall we say. and I think that concentrating on getting that right before planning insane global domination is the right thing to do. But I think there are opportunities, and there's lots of very interesting countries.
Right. Any questions there? We got one down here.
Yeah. Can you talk about your respective underwriting policies, like what criteria you weigh more heavily than others, and how this might differ from the US?
Yeah.
Who wants to take that? Yeah.
Yeah, we're in our executive team, we have over 100 years of credit and lending experience. We have a human input into a very detailed credit model. We're on 3rd generation. We're developing a very sophisticated credit model, which can only do so much, of course. We take security as the belt and braces behind that credit model. But in business lending, we're lower volume, so we've currently done 100 loans or so. And that's very much a handcrafted approach, which in business lending and across a broad range of products, you need to have.
Okay. We've got time for probably one more question, actually. I think these guys are going to a breakout room, so if you do have other burning questions, you can reach them. But are there any other questions in the audience, or not really? Yeah?
Hi, my question is actually very related to the last question, so it's a sort of variation on the theme, so please forgive me for that. To what extent do you think your ability to deliver a superior relative customer value proposition to investors and borrowers is a function of an ability to arbitrage relatively the regulatory environment and or legacy cost structures, as opposed to you being genuinely innovative in credit assessment?
It's a tough question. Who wants to take that one?
I don't think it's a tough question. I think it's an incredibly fair question, and I think it absolutely goes to the heart of whether this industry is driving genuine value. I think that our credit, I think the world of credit is actually pretty sophisticated. I think the banks are very, very good at it. I think the innovations in peer-to-peer are not particularly in credit at the moment. I think if you're looking for real innovation in credit in the UK, which is the only market I know even a tiny amount about, and I don't know a lot, I think the payday people are the people driving real credit innovation. I think we have pretty sophisticated and very smart credit systems, and we are looking at, I would like to think, better data or wider data processes than the banks, and we're certainly better at fraud systems and things like that, I think.
I think we better leave before they throw us off the
Have we got to go?
We got to go. But they're going to a breakout room, actually, if you have further questions you want to learn more. So thank you.
Sure.